There are three very clear points in my life where I learned a new piece of information which completely changed the trajectory of my life financially. And I'm going to go over those three in this video. Number one was when I was 16 or 17 years old. I read the book Rich Dad Poor Dad by Robert Kiyosaki, and then I read Total Money Makeover by Dave Ramsey. And that was the first time that I ever learned that you can put your money to work and do something with your money to build wealth outside of your job. Number two was in my mid-20s, I read a book called The Creature from Jekyll Island. And that was when I learned for the first time what our money actually is, which changed how I looked at money. And number three was when I was 29 or 30 years old, I read a book called Built to Sell. And this book then showed me the value of actually building a real business versus just a hobby business, which changed how I looked at entrepreneurship and the businesses that I was running. Starting with the first stage, each one of these three books and these three pieces of information came to me at a different stage in my career. And this is where I think the important thing is to understand that in every stage of your life financially, there are new pieces of information which can take you to the next step. You got to crawl before you can walk, and you can walk before you can run. And sometimes people want to start running before they start crawling, and then it's not going to make full sense to you. And you have to understand the different stages, and it doesn't matter what age you are, how old you are, or where you are in your job. It's learning these financial things that can allow you to start crawling towards your wealth. Then you can start walking towards your wealth. Then you can start running towards your wealth. And the first thing that I learned, this is from Rich Dad Poor Dad and Total Money Makeover. I had never grown up learning about any sort of financial education. The extent of the financial education that I had was, if I want to become successful, I got to study hard in school, become a doctor, make a lot of money, and save a lot of money. That was the extent of my financial education, that if I have a big savings account, if I save a lot of money, I'm going to be rich. And the way that you make a lot of money is by becoming a doctor. Period. When I read these books, that was the first time that I ever learned about this concept of investing. I had no idea what investing was. I didn't know what rental income was. I don't know what real estate investing was. I didn't know what dividends were. I didn't know any of that. I didn't know this whole world of financial education existed. And this is where everyone's journey towards financial education needs to start, because prior to reading these books, I was making money. I was working on my own entrepreneurial ventures in high school. I was running teen parties in high school, and I was making a little bit of money. And when I was doing that, all of my money was being funneled directly into two places: my watch and my car, period. I was spending money on expensive watches. I remember the first time I had $1,000 in my bank account. It felt like $1 million back then. And I was like, well, I made $1,000. I need to go put this money to work. And so I spent hours, countless hours, researching the flashiest and the blingiest watch that I could find. And I found this watch that was studded out in crystals that looked so cool. And it cost me like $1,000. I think it was $998, which was all the money that I had in my bank account. And I was like, what a great investment. It's going to make me look so cool. It's going to make me look so blingy. And I spent all my money in that watch. Then as I made more money, I put it in my car. First, I upgraded my rims. Then I put in HID lights. Then I put in a new sound system in my car. I put in subwoofers in my car. I upgraded every single thing in my car, because now when I made money, instead of saving it, instead of investing it, I was just throwing it in my car because that's what I thought was normal. That's all that I knew. So then I started reading books, and I started learning about this whole concept of investing. And I learned about this concept of building your own wealth financially, because in my mind, wealth meant you got a good job, and that's it. In my mind, your wealth was linearly correlated with the grades that you got in school. If you got good grades in school, you were going to become wealthier, period. That's how I thought it worked, because, I was naive, but that's what I thought the system was built around. But it's not like that. It's completely different. In fact, the financial education, the financial wealth that you achieve is very different than the grades that you get. And that's what really frustrated me initially, because we go to school to get good grades, to get a good job, to make good money. And so ultimately, the kind of A to D point is we think that by studying hard, we're going to make good money. And that if we study harder, we're going to make more money. And if we study even harder, we're going to become richer. But there's a disconnect between your grades and the amount of wealth that you build. Now, there's nothing wrong with doing good in school. There's nothing wrong with getting a good job. But there's this disconnect of the wealth that you achieve and the education that you get in school. because that's the financial education. What you do with your money, how you become wealthy is very different than the job that you have. It's very different than the grades that you receive. And that level of financial education is what really frustrated me, because I assumed that I was doing everything right in order to become financially wealthy. But in order to become financially wealthy, it's not by becoming a doctor. It's not by getting the best job possible. It's by understanding what you can do with your money. Somebody can become richer with $50,000 a year than somebody making $150,000 a year if the person making $50,000 a year knows how to live below their means. They know how to put their money to work, and they stay consistent from the day they turn 21 for the rest of their life. They stay consistent and they continue eating away at their investments. They keep throwing money into their investments. They will become wealthier than the person who is making $150,000 a year, who is blowing all of their money, who doesn't have any savings, who's not putting money aside for their investments. The person making a third of the income will become richer, will become wealthier, and will have a more financially free life. And that is where that financial education comes in. And so now understanding, number one, that you control your financial future. Not with your job, not with your grades, but with your choice of what you do with your income. If you take your income and you blow all of it, you will never have a chance to ever become wealthy, period. You need to take your income, and what wealthy people do is before they go out and spend their money, they invest their money, period. Wealthy people want to make themselves rich before they make everybody else rich. This was the biggest mind messer-upper that I've ever felt, because I was so confused when I learned that you can buy something that will make you money. I think this was Robert Kiyosaki that was talking about this, where you can buy essentially these little boxes. Every time you get paid, you buy these boxes and then they pay you. Now, this is not an actual box. This, in this case, is an asset like a rental property. You're buying this thing with the purpose of making money. But that concept was so mind-shattering to me, because I, up until that point, was only using my money to buy liabilities. Liabilities are some things that take money away from you. Your car is a liability. When you buy a car, it's losing value. When you buy clothes, it's a liability. It's losing value. When you go out and buy a vacation, it's losing value. When you go out and buy food, it's losing value financially. All of these things are liabilities. You spend money on these things and you never see that money again. Versus what wealthy people are doing is they want to buy assets. The first thing that they want to buy is something that's going to put money in their pocket. Go out and buy a rental property. That way now a tenant is going to pay you every single month. Every first of the month, you get a new check in the mail. Or you go out and buy something like stocks, where now you can get paid with dividends. Every 3 months, you get a check. Or the company's working to grow the valuation of the company. Or you go out and you can buy an actual business. That way now, every day, this business is trying to drive more revenue, which is putting more money in your pocket. These assets cannot be showed off the way that you can a liability. You cannot show off your rental portfolio the way you can a Gucci belt, but this rental portfolio can buy you a lot more Gucci belts than $1,000 in your pocket can. And so this is where now it changes the way that you look at money, and it changes what you do with your money, because now when you understand that you can use your money as a tool, you're going to want to stop using your money as a fool. And that's the first step to any sort of financial education, is that realization that you can use your money to buy assets. Assets can pay you, which means you can use your money to create more income. You can use your money to make more money. Versus everybody else, the majority of people are using their money to make everybody else richer. And if you want to become wealthy, the first thing that you have to do is understand this, and understand that you can use your money to make yourself rich, and your income is what's going to determine whether you do that or not. It's not how much money you make, it's what you do with the income. Now, once you understand this, that's when you can use your income to grow your income, and you can work to grow your income, because now the more money you make, the more money you can invest, and the wealthier you'll become. But it starts with using your income as a tool instead of just making everybody else around you rich. The second point that really changed the way that I looked at wealth and money, and changed the trajectory of my life financially, was when I read that book, The Creature from Jekyll Island, which talks about the history of the Federal Reserve Bank, and it also talks about what our money is as paper. Because, see, I think all of us, growing up, we assume that our money, our paper dollars, our currency is valuable because everybody else around us values it, right? I mean, if you have $100 in your pocket, you feel rich because it's so valuable. But then you got to start asking yourself, which is what this book did for me, what is that $100? Because see, our currency, our money, what we call money, is not backed by anything tangible. It's just pieces of paper. In fact, it costs about 12 cents to print a $100 bill, which means what is the real value of that $100? Is it a pair of shoes? Is it a dinner? Is it something else? And this book really started to question this for me because, one, I had no idea of what the history of money was. I had no idea what the history of the Federal Reserve Bank was. I had no idea of how our monetary system actually worked. And this is where it is very important to understand this. That way you can change the way that you can also use your money. Because our money used to be backed by physical gold. Meaning, if the government and our Federal Reserve Bank, our central bank here in the United States, wanted to print more money, they wanted to spend more money, they needed more wealth. Where did this wealth come from? Well, one way to measure wealth was the amount of gold that you had. Well, in 1971, that all changed because President Richard Nixon in 1971 severed the ties between the gold standard and the dollar, meaning he took the dollar off the gold standard, meaning the Federal Reserve Bank and the government could spend and print however much money they wanted because you didn't need more gold to justify printing more money. That was when money went from money to just fiat currency. Fiat currency means pieces of paper that are backed by the promise of the government saying that this piece of paper has value. Now, what happens when that shifts from money to currency? Well, the first thing that happens is you see this economic boom because now the government has the ability to spend pretty much an unlimited amount of money because they have a money printer backed by the Fed, which allows them to finance their operations. So if the government wants to spend, say, $1 billion on building bridges or hiring police officers, they can do so because they can just print the money out of thin air and do that. But there is a cost to doing this. There's a consequence to doing this. I mean, if there was no consequence, why do we have to pay taxes in the first place if the government can just print this money out of thin air? And the consequence is, well, inflation. Because now when you keep printing money, there's a consequence to that. When you print money, you create more currency. The value of each individual dollar goes down, causing the price of things to go up. That is what inflation is. Inflation is inflating the monetary supply. And so now when this really started to accelerate in the early 1970s, this created a new game where the United States then went from being the largest creditor nation in the world to then the largest debtor nation in the world. We were the largest creditor nation in the world, meaning we were the wealthiest country and we were lending money to other countries around the world. Other countries around the world went to the United States as the bank, the World Bank, to come and borrow money, and we would finance their operations and get paid interest. In the mid-1980s, that flipped. The United States then became the largest debtor nation in the world, which means we no longer were the world's bank, we were the person in the most debt. That started to change again, the value of the dollar and the value of our money. And so the inflation never went away. And inflation is one of those concepts that most of us never really understand. I mean, inflation only became popularized after the 2020 pandemic. And I know this for a fact because, well, two things happened. My first video on this YouTube channel to go viral was a video titled "You're Guaranteed to Go Broke If You Do This." And I released this video back in 2016. And what you have to understand about this is back in 2016, inflation was between 2 to 3%. And it was low enough to where most people had no idea of what inflation was. And when it was at 2 to 3%, it was still there. Inflation was still around. It just wasn't talked about much because it wasn't that big of a deal. It was low enough to where it didn't really affect people. And I know this because I also, around 2017 and 2018, I used to walk around the streets of the United States. I walked around Washington, D.C., I walked around New York, I walked around Chicago, I walked around San Francisco and Los Angeles, asking people on the street, what is inflation? And most people had no idea of what inflation was. And these aren't just uneducated people. I asked professionals, attorneys, different types of people in different industries what inflation was, and most people, the vast majority of people, had no idea of what inflation was. So this was my data going out there and talking to people about inflation, and most people have no idea. Now, what is inflation? Inflation is a hidden tax. Because see, if the government wants to go out and let's just say they want to spend $1 billion building a brand new road, if they wanted to do that, generally they would need to impose a tax to raise the money to go and have the money to build this road. If the government imposed a 1% tax on rich people to build this road, we know where that money is coming from. Because the government charges a tax on a particular person, this person pays a tax, the government has the money, then they can go out and build the road. But what happens now if the government does not go through legislation? They do not go and get the votes to raise this tax to build the road. The government has then two options. They can either A, not build the road, or they can B, still build the road and find the money somewhere else. And what has been happening is governments love picking option B, because why would you not want to spend and stimulate? And so what the government has been doing is, well, okay, if we can't get the votes to get the money to build this road, we'll just print the money to build this road. And now when you go and print the money to build this road, which is now the national deficit, which is something we've been building up for many years now, which then piles onto the national debt. The national deficit means the government is spending more money than it brings in, and the national debt is all of our excess spending. So we have spent a lot of money, right? We have this about $32 trillion worth of national debt, meaning the government has spent $32 trillion it didn't have. Well, how did they get this money? Well, a big chunk of that is the Federal Reserve Bank is printing this money, and then they're giving it to the government. So now the government is printing this money, getting this money, and then they are spending it. Well, what's the cost of that? We know that if the government is imposing a tax, we know who's paying for it. But if they don't charge a tax and they still spend the money, then who's paying for it? Well, now it's everybody else. That's what inflation is. It is a hidden tax. And the person who bears the burden of this hidden tax is the person who doesn't understand what inflation is. Because now when the government goes out and they print $1 billion to go build this bridge, or they go print this $1 billion to go spend whatever they want, everybody pays the price of that through inflation. But the average person who doesn't understand what inflation is going to bear the burden of that, because inflation disproportionately hurts the financially uneducated and the poor and the middle class, and it disproportionately benefits the wealthy. And the reason why is because inflation hurts consuming. It hurts consumption, because inflation causes the value of your dollar to go down, causing the price of things to go up. That's what inflation does. And so now when you go to the grocery store and you want to buy groceries, you need more dollars to buy your groceries. When you go to Lululemon and you want to buy some leggings, you need more money. When you want to go on a vacation to Cancun, the airline and the hotel is going to cost more dollars because the value of your dollar goes down. So consumption becomes more expensive because now the value of your earnings isn't as much, the value of your savings isn't as much. And the average person in America is only a consumer. And so now when you're only a consumer, inflation is only hurting you. But inflation can also benefit you if you are an investor, because now when you're an investor, you own a business, inflation also means that, well, you can charge more money for your groceries. You're charging more money for the pants that you sell. You're charging more money for the airfare that you sell. So inflation means more dollars are then flowing to the investors and the business owners, but not everybody is an investor or a business owner. So now when you have the middle class and the poor who are not investors, they're only consumers, you're only being hurt by inflation. And then when you have the wealthy and the financially educated who are investors and business owners, you're being benefited by inflation. Now, inflation has been going on for decades. But inflation disproportionately hurts the financially uneducated, and it disproportionately benefits the financially educated because most people are only consumers and they're not investors. And when you're only consuming, inflation keeps hurting you. And this is where now, if you don't understand this, you become a pawn in the system, because now you're constantly working to earn more money. You can't figure out why you can't get ahead. The cost of living keeps rising. Your wages might be growing, but you feel like you still are struggling to have more money to invest, have more money to do other things, because the prices of things keep rising, your rents keep rising, home prices keep rising, grocery prices keep rising, travel costs keep rising. Well, that's what inflation does. Inflation is a hidden tax, and when you don't understand this, you're going to be the one that constantly keeps paying the price, which is why you have to understand what money is. Now, it helps to understand what money is when you also know what you can do with your money. That's why it's important to also understand the different tools that you have of how you can invest your money and how you can budget and how you can build these systems with your wealth. But you have to understand what money is then, because that's going to be then the next motivation of how do you invest and why do you invest. Because now when you start learning about what money is, you're going to be motivated to now put your money to work, but then also invest your money in particular places, understanding what hard assets are. How can you create more income? What are different places that you can put your money to work? That way you can protect your money against inflation, because let me tell you something, inflation is not going away. Everybody who thinks that things are going to go back to normal in a couple of years because things are going to go back to the prices in 2019, you're living in a delusional la-la land, and this is where you need to understand inflation is going to be around. Now, how do you protect your money, build your wealth, and grow the amount of income that you have coming in? This is what understanding money can help you do. This then brings me to number 3, the third stage of my financial career. I read a book called Built to Sell. This book was very interesting because I've always been an entrepreneur. I've always been into this idea of I wanted to build a business, and I've built a lot of businesses. Some of them have even made me a lot of money. But what Built to Sell talks about more particularly, and if you're an entrepreneur, I highly recommend every single one of you read this book, is if you want to build a real business, not just a hobby, something that's real, something that you could potentially sell, a real asset, then you have to build a business that you can plug yourself away from. And this is something that I knew in the back of my mind, but I never really understood it until I read this book, because when I was in college, I started an event planning company. And this event planning company was essentially, I was hosting parties, I was hosting concerts, I was hosting shows, I was working on weddings, and I had essentially created my own job. I was making good money for a kid in college, and I had cool opportunities, I was doing cool things, but if I wasn't doing something, I wasn't getting paid. So it was a job that I had created for myself. Yeah, I created my own job. I was my own boss. I was making good money, but it wasn't a business. I couldn't sell this business. I couldn't hire somebody to do what I was doing. It was just me. So the value of that business was really just my income. And I learned this then, and I started working on different things that I felt were more scalable. I wanted to get more on the internet, and I did other e-commerce businesses and did a bunch of other things because I wanted to build something scalable. But it wasn't until I read this book that I learned about this idea of being able to extract yourself. How do you hire a new CEO? Can you remove yourself from the business and just own the business? Because now when you have a business, there are two ways you can get paid. You can get paid as a salary, as an employee in the business, or you can get paid with the profit. And your job as a business owner, as a truly wealthy person, will be to rely on the profit rather than just the salary. Because this is the same reason why you invest. When you invest in a company like Amazon, you're not getting paid a salary from Amazon. You're getting paid when Amazon makes more money, right? Maybe you get paid with dividends, or you get paid when the stock price goes up. That's how you get paid. Well, now, if you are building your own business, you have value in the company itself, but you can only realize that value when you learn to turn it into a real business. And if you're an entrepreneur, well, wealth is built through building businesses. Some of the wealthiest people in the world got there because they built businesses. In fact, most of the wealthiest people in the world got there because they built businesses, but they didn't build businesses that relied on them to do every piece of the job. They built businesses where there was that scalability aspect where they can extract themselves. So the idea now is, if you have a business, how can you build systems, hire people, and have a team where now you can pull yourself out of? You can fire yourself as a CEO. You can hire a new CEO, pay them a salary, maybe pay them a revenue share or a profit share, that way they're incentivized to grow the business, and then you can leave. Now, when you leave, if the business can continue to operate and the business can continue to grow, the profit, the money that's left over in the bank account, that then becomes yours because you own the business. As the owner of the business, you get access to the profit and you get access to the equity, meaning the valuation of the company. As an employee in the business, you get access to a salary. Now, a salary provides comfort because you get paid every 2 weeks. But as the owner, that profit, that's the last person to get paid. The owner is the last person to get paid because now you got to pay all the employees first. You got to pay all the contractors. You got to pay all the software people. You got to pay all the banks. You got to pay all your debts back. And then if there's any money left, that's the profit. But if you can build a true business that is now built with a sellable mindset, even if you don't want to sell your business. Well, now you have real equity in the company because now this company will have a value as well. There's a valuation of the company, just like how there's a value of the home that you own. When you have positive equity in your home, now you could potentially sell that home, or you can pull cash out of the home through a refinance if you wanted to. You have that option. When you own a business and you have true equity in there, it's the same thing. When you have a business that does not rely on you, now you have built a new income stream through that profit, through that equity, through that valuation, which you can then monetize by either selling it or potentially pulling cash out if that's something you wanted to do. But it requires you to understand that you can build a business that's outside of just you and the labor that you put in. CNBC put out a really good article titled Financial Experts Share Their Greatest Money Regrets, and they all have one thing in common. And I think this article really explains very well the money regrets that people have in their 30s. So I want to go over the 5 money regrets that CNBC talks about here because, well, I think these are really powerful ones. Let me start with number 1. The first money regret that they talk about is I did not negotiate my first salary. And the reason why this is so powerful is because I don't think many people realize that everything is negotiable. And this includes your salary and everything else. See, like when you go to India, which is where my family's from a state in India called Punjab, you negotiate the price of anything. If you go to the local bazaar, you go to the people on the street selling fruits, and you want to buy apples, you're going to negotiate the price of apples. You negotiate the price of everything over there. Here in America, you barely negotiate the price of anything. Maybe you negotiate the price of your home, but that really just depends on the housing market. Maybe you negotiate the price of a car, but that's really it. But everything is negotiable, and the worst that someone can say is really no. And I want you to remember that because there's a lot of opportunities if you just ask. Now, maybe they'll say no, but at least you tried. And I'll give you an example of this because when I got into law school, I got a scholarship from the university that I got accepted, or I got a handful of scholarships, but the university that I wanted to attend gave me a pretty good scholarship, but it wasn't as good as some of the other universities that had given me scholarships. So when I got the scholarship offer, I said, thank you. And then I also said, I'm really interested in coming to your university. This was Wayne State University, but the scholarship offer that you had given me isn't as good as some of the other universities that I got. And then I told them that some of the other universities gave me scholarships of this size. Is there anything that you can do to help meet or match this scholarship offer? And I sent them the other offer. Now, I wasn't lying when I said this. I actually had the other scholarship offers, which gave me a little bit more leverage here. I sent them the email. I was already accepted into the university. So I didn't think that they were going to revoke my acceptance for trying to ask for more money. I was just trying to see if they'd be willing to give me more money. It took me maybe, 5 minutes, 7 minutes to write that email. And they responded with a yes. And they gave me thousands of dollars more in scholarship from my 5 or 7 minutes that I spent writing that email. Everything is negotiable, and the worst that somebody will say is no. And if they say no, then you can figure out what it will take to actually get the higher salary. But ask. It's okay to ask. It's okay to be looked at like you're weird, but you have to ask. Otherwise, you're never going to get it. Money mistake number 2 is leasing too much car. And this is probably one of the most common money traps and money regrets for people in their 20s and their 30s, which is where you assume that you have to go out and lease or finance a car because everybody else is doing that. And if you're going to finance a car, focus on the monthly payments. And if you can afford the monthly payments, well, you can afford the car. When in reality, you are spending a ton of money on something that isn't making you any money. And when you're trying to build wealth, you need to be focused on making your own self rich first. Right now, the average new car payment in America is $716 a month. That's over $8,500 a year. just in your car payments. So let's do the math to see how much this is really costing you. If you spend $8,500 a year on your car payment, and this is assuming no premium gas, no expensive insurance, no expensive maintenance cost, just your car payments. And if you do this for 30 years, because guess what happens is when you finance this car, you're going to drive this car for a few years, and then the financing is going to expire, and then you're going to get a new car and start the payments all over again, and your payments never shrink, they just keep going up. So I'm being generous here, talking about $8,500 a year for 30 years. And if you could have got a return on this money, if you could have got a basic 10% return, that means that your car payments could have been worth $1.5 million worth of wealth. When in reality, what is it going to actually be worth? Well, you're going to be driving a car when you're 65, and maybe it'll be worth $40,000. So instead of having $1.5 million, you just have a car in your driveway. And this is where I want you to focus on making yourself wealthy first. This is going to be painful, but I want you to do is get rid of the car payments. Instead of putting $8,000 down to finance a $50,000 car, take the down payment, the $8,000, and drive an $8,000 car. Yes, you can get an $8,000 good working condition car. Look for a Toyota Corolla, maybe even a Toyota Camry if you can find one, a used but good working condition car, and now you got a car that doesn't need payments. You don't got to have the expensive insurance. You don't have to have the expensive premium gas. You don't have to have the expensive maintenance. And now that $700 that you're not sending to the car company and all the other payments you're not sending to the insurance companies and the maintenance companies, take that money and invest it. It's going to free up a lot of monthly cash flow. Now when you start investing this money, all of a sudden you just got a huge boost to your investment portfolio. As you start to grow this, well, you might start generating some cash flow from your investments. Once you start getting some cash flow from your investments, or once you see your investments start to grow, or as you start to make more money, then you can start upgrading your car. And then you can buy a car with cash that you can afford without having to worry about the price. Because when you don't have to worry about a monthly payment on your car, I can tell you this, you are going to breathe a whole lot easier, because now you don't have to worry about $1,000 a month going towards your car, and $1,000 is your car payment. It's the premium gas, it's the insurance, it's the maintenance, it's the brake repairs, it's the upgrades. All those costs add up, and if you can save all of it and reallocate that money towards your investments, you will be able to build so much more wealth by not even changing that much of your lifestyle, besides just downgrading your car a little bit for a little while. Money mistake number 3 is going all in on tech. And I think this is an important investment lesson, because you see this in pretty much every asset class that's booming. When you see an asset class that's booming, if you're not an experienced investor, even if you are an experienced investor, it's very easy to get caught up in the hype. In the late 1990s, that was putting your money into tech stocks, because all these online companies, if you had the word .com next to it, were able to boom in valuation, and people were making money hand over fist. So it was very attractive to then follow the hype, follow the crowd, and start throwing your money into those .com companies. Well, what happened? Well, 2000 came, 2001 came, and the dot-com bubble burst. And the people that didn't know what they were doing lost money. Even the people that knew what they were doing lost money. So it's very easy to get caught up in the hype, throw your money in, and then not know what's going on. This doesn't mean that tech companies died or the dot-com companies died, but that bubble burst, and then only the good companies survived. Like even Amazon stock fell to under $1 after the dot-com bubble bursting, but Amazon didn't die. But the people that didn't know what they were doing lost a lot of money through it. In the mid and early 2000s, it was the real estate market. People were buying homes with no money down, with subprime credit scores, and then sometimes buying multiple properties because you didn't need any cash to go to the down payment. You could just buy homes and then sell it for huge profits 6 months later. People started to get in. Everyone was telling their cousins and their friends of how much money they're making, and then everybody and their friends and their cousins and their moms started buying real estate. Well, what happened after that? The 2008 dot-com bubble burst, and that party ended. Now, does this mean real estate died? No. The real estate market just changed, and it changed the way that people started investing, and the people that didn't know what they were doing lost a lot of money because of that. In the mid-2010s, what was it? Well, you saw cryptocurrency. The cryptocurrency boom happened. Everybody thought that cryptocurrency was going to be an easy and quick way to get rich, and cryptocurrency went from essentially nothing to about $20,000 A coin, Bitcoin went to $20,000 a coin almost. And then the cryptocurrency market collapsed. And then the people that started chasing the hype and was chasing what everybody else was doing lost a lot of money. And we see this trend happen again and again and again. The asset class changes. You see it happen in the stock market. You see it happen with particular industries in the stock market. You see it happen with real estate. You see it happen with artificial intelligence. You see it happen with blockchain. And this is where now when you chase the next hot thing, you feel like you're making a smart investment decision. You feel like you're going to make a lot of money. You feel like you are making a lot of money, but then bubbles eventually burst. And the people that don't understand what they're doing, they didn't understand what they're buying, were the ones to lose everything. And this is where now your job as a financially smart investor is not to be a chaser. Stop chasing the hype. Don't follow what the media says because, well, the media is in the business of either telling you that everything is going great and nothing can go wrong, or that the world is ending. And when you invest based off of what the media is saying, well, you're going to be very emotional. And if the media has already covered it, well, you've already probably missed that rally. And this is where now your job as an investor is to cut through the noise, avoid all the hypey stuff, avoid all the exciting stuff, and just focus in on the investments that are there that have been proven to build long-term wealth. And this is where now, as you're researching, you don't want to just read all the titles. Read the actual information. Read press releases. Read the data. That way you don't get bogged down with all the emotion. Now, if you don't want to, don't have the time to do that, the next best thing would be to read something like Market Briefs. Market Briefs is my free financial newsletter that I created to help investors, regular investors, stay up to date on what's happening on the top financial news. It's a daily newsletter where my team is breaking down what's happening on things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market, or you can click the link down in the description below. Money mistake number 4 is unloading inherited stock. Now, I don't know too much about inheritances like this, but I think the whole idea goes down to selling investments. And this could be investments that are given to you or even investments that you buy. Because personally, I'm not a huge fan of selling. I like holding, particularly in places like real estate, because now my goal is to stack cash flow. When I invest in real estate, I know that I can make X number of dollars a month per unit in this property. Let's just go with round numbers that for every unit, I'm going to make $500 a month. If I buy a single family home, it's going to make me $500 a month. If I buy an apartment complex with 10 units, that's going to make me $500 per month per unit. So that's $5,000 a month in that apartment complex of profit. Sometimes more, sometimes less. I'm just going to stick with round numbers. Now the name of the game is how many units can I stack? How can I stack my cash flow? And sometimes it's very attractive to sell because you see the opportunity to flip this property into a bigger property. And there are certain times where it is useful. I don't say never sell, but I try to avoid selling because my goal is to accumulate a larger portfolio. The times that I've sold are primarily properties that are just big headaches. There was an apartment complex that I bought on a lake. I think it was 16 units or so. And I turned this property around. I built a lot of value in this property. When I bought it, it was completely vacant. It was just not in a good shape. I came in, I turned it around, got tenants in the property, but it was just causing a lot of headaches because the types of tenants that were in this property were just constantly fighting each other and just kept causing a lot of maintenance issues and a lot of management issues that I didn't want to keep dealing with. And I had a lot of new equity in this property, which I just didn't want to keep dealing with the headache. So I sold off the property, realized that equity, and then flipped this money into now a different property. So there are times and places where it will make sense for you to sell, but in general, I'm not a huge fan of selling because I want to own, I want to accumulate, and I want to grow. I want to keep building and buying more because then I can just stack the cash flow. Take the cash flows from one, add on the second. $500 a month, now $1,000 a month, now $2,000 a month, now $4,000 a month, now $8,000 a month, now $10,000 a month. That way you can stack the cash flow. But the only way you can do that is if you keep accumulating and growing. And selling can be attractive, especially when you see the valuation of your assets go up. But if you don't have an investment to buy into, well, now you might be losing a great cash flow producing asset, or you might be losing a good asset with no place to actually put that money. So you have to think, where's that money going to go before you sell? And if you don't have a place to put that money, you definitely want to think twice before you sell. And money mistake number 5 is not considering long-term care. Now, I've seen this firsthand because I've seen the expensive costs of having to take care of elders who need additional nurses, they need additional care. So this is where look into insurances that can help you take care of your parents, or that can help you and your kids when you get older. There's a lot of different insurances that you can look at that can help you as you get older, long-term care types of insurances, something for you to look into or start budgeting towards. That if you start to get older, you know that you're going to need more health concerns, health costs in the future. Have the money there to help protect you. And you can also consider looking into getting some life insurance. Personally, I'm not a huge fan of whole life insurance. I like term life insurance because it kind of provides you a bridge as you're building your assets. I don't want to rely on life insurance to take care of my family or me. I want my assets to take care of my family and me, because now they can take care of me when I'm alive. They can take care of me after I'm gone. And every whole life insurance salesperson is going to tell you all the benefits of whole life insurance, but it's really making money for the insurance company and maybe making some money for you. There's a lot of things going on with there. That's why I like term life insurance. It keeps the control in my hands, in my pockets. Now, if you want to learn more about how you can get term life insurance, there's a bunch of companies on the internet. You can check out my affiliate company if you want. I'm a partner with Policygenius. I like them just because of how streamlined they are. You don't have to use them. Find a company that's right for you. But if you want to check out Policygenius, I got my affiliate link down in the description, which means if you use them, we will get compensated, but there's no additional cost to you. So if you have questions about life insurance, check them out. They have teams of people that you can talk to as well. But life insurance is essentially now, if something were to happen to you unexpectedly, your family can at least be compensated with a big check. That way, at least financially, they will be taken care of. If your goal is to become wealthy in your 40s and potentially retire in your 40s, it's not going to happen by getting small annual raises and then contributing money into your 401k. Take a look. The way that anybody can become wealthy is by doing 3 things. Number 1 is you got to spend less money. Number 2 is you got to work to earn more money. And then number 3 is you got to invest the difference. That's how you become wealthy. And if you want to become wealthy sooner, you're going to need more money that you can actually invest, because you need money that's working to make you more money. Now, when you have money coming in without you having to go to work, that's when you can be financially free and retire, because now you have enough income from your assets to cover your lifestyle. And if you want to have this financial freedom sooner rather than later, you need more money today going out to earn you more money. And what I want to do today, right now, is I want to go over 7 practical steps, things that you can do right now. That way you can achieve this sort of financial freedom, this retirement, this wealth, whatever you want to call it, sooner rather than later. Maybe even as soon as your 40s, if you start in your 30s, maybe even 20s, if you start putting these things together. And I want to get very granular about practical things that you can start doing right now. Number 1 is do not finance or lease your car. Buy a car with cash that we don't have to worry about the payments, and take the money that you're no longer having to send into your car company, that you no longer have to pay in the expensive insurance, that you no longer have to spend in the premium gas, that you no longer have to spend in the expensive maintenance, and invest that money instead. The average new car payment today is over $700 a month. Take the $8,000 that you had to put as a down payment on your $50,000 car and buy a car with that $8,000. Find yourself a used but good working condition Toyota Corolla. This will get you from point A to point B. It will not have as many issues, assuming you buy a good working condition car. And now you got a good car that will take you to where you got to go. And now you're going to free up a lot of cash flow every single month that you can use just to build your wealth. Remember, if you want to become wealthier sooner, you need more money going to your investments. That way you have more money building your wealth sooner rather than later. Number 2 is live smaller. Have a smaller home. This could be whether you own a home or rent a home. It really does not matter. You don't have to own a home. You don't have to rent a home, but you have to live smaller. You know, they say if you go to a realtor, if you go to a bank, they're going to give you somewhere between 28 to 33% of your gross income going to your housing payments. If you really want to become wealthier, you want this to be closer to 20%, where now your housing costs are significantly a smaller piece of the amount of money that you're bringing in. That way now you have more money to put towards your investments. Now, again, this isn't very fun. You might be able to qualify for a $500,000 home, but you're only living in a $300,000 home. And the reason why is because you don't want to live so big. When you have a bigger home, Well, you're going to have more expensive utility bills because you got more space, you got to heat, more space, you got to cool. You have more expensive maintenance, more expensive upgrades. Well, when you have a smaller home, your costs also get smaller and you have less money going to the bank or your landlord every single month. And that means more money sitting in your pocket. Again, this is not the most fun thing to do, but if you really want to become wealthy sooner rather than later, you got to go through what I call the decade of sacrifice. Doing the things that nobody else is willing to do, that way you can have the wealth that most people dream about having, but you're going to have to put in the sacrifice and the work in order to do that. And the most accessible place for you to do it is your car and your home, because those are the biggest expenses for the average person. And so now if you can reduce the size of your biggest expenses, we can have big extra savings that you can use to building your wealth. And 10 years from now, you will have way more wealth, way more financial freedom because you put in that sacrifice right now. And so if you want to have that financial freedom sooner, you're going to have to make more sacrifices today. Number 3, when it comes to your home, instead of buying a single family home to live in, consider going out and buying a duplex or a triplex or a quadplex, a 2, 3, or 4plex, because in the United States, there are some special regulations out there which say that when you go out and get a primary residence can be a single family home, but it can also be a 2plex, a 3plex, or a 4plex, which means if you go out and you buy a 4-unit building, you can live in one of the units yourself and your neighbors can pay your mortgage for you. Now, you still have a place to live, but you don't have to worry as much about your monthly payments because now your tenants, your neighbors, the people that live in your building are going to be paying you rent every single month. And if you do it correctly, you might not have to pay any money to your bank. You might not have any mortgage costs. You might not have any housing costs because your tenants are paying your rent for you. Now, of course, this is where you do want to make sure you talk to an attorney, but this is a very commonly and very widely understood little loophole which will allow you to own a little rental property and have your tenants pay your mortgages for you. Now, there's a second little part to this that you can also do, which is now you have the ability to live in that property for a year and then a year and a day later move out and do it all over again and then rent out the unit that you were living in. Because generally, you cannot rent out your own primary residence. When you go to the bank and you get a mortgage for your primary residence, the place that you're going to live, you can't the next week go rent out this property to somewhere else because it's your primary residence. Banks have different loans to investors, so you can't do that. But if you live in this property for a year and a day, then you have the ability to move out and have somebody live in your property. So now you can do what I just said. You buy a 3 or 4 unit property, you move in, you have the tenants pay for your mortgage, pay for your housing costs, or at least significantly reduce your housing costs. And then a year and a day later, if you want, you can move out. And then you can have somebody else live there. Now, hopefully this will start generating you some cash flow, and then you can start this process all over again. So now you have the income from this first property paying for the second property, and now you're working to build a portfolio of properties as you're working to get closer to that retirement. Or if you wanted to sell the property, if you have some new equity built in there, this equity can also be sold generally tax-free depending on how much the profits are. And now these limits are always changing, so you want to make sure you understand that. But this is where now you can use the place that you're living as a catalyst to your wealth if you do it strategically. The fourth thing that you can do is ditch the Netflix subscription. Not so you can save $15 a month, but so you can save 2 to 3 hours of your time every single day. There was a study recently put out that said that the average American is watching about 3 hours of television, aka Netflix, a day. Not a week, a day. Now, the reason why so many people struggle with making more money is they feel like they never have more time. And you don't have the time if you're always watching TV. And this is where now, if you can cancel the Netflix subscription, you got this new block of time, 1 hour, 2 hours, 3 hours to do something. And what I want you to do is start by learning. Learn how to increase your income. Learn how to invest. Start spending the time reading books. Start spending the time watching educational YouTube videos. Start spending the time listening to educational podcasts. And then start spending the time doing something to earn more money. Because right now, if you want to be able to achieve that financial freedom sooner rather than later, remember, you got to spend less, earn more, and invest like crazy. The more assets you own, the more freedom that you're going to have. How can you own more assets? You can either spend less money or you can earn more money. You got to have a margin with what you bring in and what money leaves. And so one way to have a bigger margin is by earning more money. And in order for you to earn more money, you got to be learning. And you can't learn unless you have the time. So right now, get rid of the Netflix subscription. Yeah, I know you want to watch whatever shows are on Netflix right now, but this is that time. You want to go through the decade of sacrifice so you can have the wealth that nobody else has, where you're going to have to do the things that nobody else is willing to do. And that means giving up some of that TV time, that way you have more learning time, that way you have more earning that can buy you more assets. So use your time to learn how to earn, that way you have more money coming in. This brings me to number 5, which is actually now go out and work to earn more money. Because now your learning will help your earnings. So now when you start learning, you can start spending this time also in your evenings and your weekends and your holidays, now working to earn more money. This can be either as a contractor, as a freelancer, as a new business that you're working on, as a second job that you're working on. That way you're working to earn more money. But the key here is when you're working to earn more money, you're not working to earn this money to drive a faster car. You're working to earn this money. That way now you have more money buying you more assets. Because if your goal is to retire in your 40s, if your goal is to have the financial freedom in your 40s, 10 years from now, you need to own more assets, which means you got to get laser focused on just accumulating and buying the assets. Again, this is not easy. It's not fun, but it is very exciting when you start getting closer to that goal, because then you're going to have a lot more freedom. And if you're willing to put in the sacrifice that nobody else is willing to do, you can have way more freedom than most people dream about having. And this is where right now you're going to have to work to earn more money. That way you have more money to buy more assets. You go through this like hockey stick curve where you're going to put in all this work in the beginning. No one's going to recognize it. No one's going to see it. Even you are not going to see any of the gains. Even you're not going to see any of the returns, and you're going to wonder where all your time is going, where all your efforts are going, where all your money is going. But then slowly you're going to start to see a turn. And as you start to see a turn, you kind of see this hockey stick growth where, oh yeah, now everything's starting to compound. Your education is starting to compound. Your earnings are starting to compound. Your investments are starting to compound. And that's what you need to be working for, is right now staying focused on spending your time, spending your money, and spending your energy working to build that wealth. And that wealth is through the right assets. Number 6 is do not get flashy with your investments, because now what's going to happen is you're going to be working hard to put money aside to accumulate these assets, and then you're going to see the cool and flashy and exciting opportunities come your way. Maybe it's a meme stock. Maybe it's the next hot cryptocurrency. Maybe it's a no money down real estate deal. Maybe it's the next hot stock. But this is where you have to stay consistent and remember that if it seems too good to be true, well, it probably is. There's always going to be bubbles forming. There's always going to be the next exciting investment. There's always going to be the next speculative investment. And they have the potential to 10x your money very quickly. But if you really want to build that sustainable wealth, you need your money going into places that are actually going to give you returns instead of gambling your money. Gambling can make you a lot of money, but it can lose you that money just as fast. And now when you're working so hard to get that money and keep that money, you want to protect it and grow it and nurture it, and not just throw it into something that is very speculative and hypey. And this is now when you're working to learn about where you should be investing. You're working to keep up to date with what's happening in the financial news. You also got to be careful to not get bogged down by all the emotions in the traditional financial media, because, well, there's a lot of emotions out there. So you have to be able to cut through the noise. And the best way to do that is by reading the press releases, reading the raw data. That way you actually understand what's happening. And the next best way to do that is to join something like Market Briefs, which is my free financial newsletter, where my team is working every day to break down what's happening in the top financial news. That way you can keep up to date on what's happening, when it's happening, without all the emotion, without all the sensationalism. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. And finally, the 7th thing that you need to do if you want to become wealthy sooner rather than later is you got to forget what other people think. Look, the world are critics. People are haters. People will judge, period. Whether you're on the internet, not on the internet, well, people are going to judge you. If you decide to do something different or not do something different, people will criticize you. If you decide to become wealthy or not become wealthy, people will hate what you do. So you might as well give people a good reason to criticize, hate, and judge you. That way you can actually have that financial freedom. Now, here's the thing. People will always have an opinion. It goes to as simple as the financial news talking about how the world is going to end or how nothing bad will ever happen. But when it comes to you now working on building your financial journey, one of the most difficult parts of becoming financially successful, which most people don't talk about, is all the criticism that you're going to have to deal with. Whether you're an entrepreneur or not an entrepreneur, you're going to have to make sacrifices. And those sacrifices will come with sacrifice. And that means people are going to look at you like you lost your mind. When you go from the BMW to the Toyota Corolla, people will look at you like you lost your mind, as if something went wrong, as if you're on the verge of bankruptcy, as if you lost your job, as if something stopped clicking in your brain. When you stop going on those vacations to Cancun, people are going to look at you like something's wrong. When you stop spending money at Gucci and Louis Vuitton and you start wearing regular clothes at Walmart, people will wonder what the heck is going on. When you stop eating out at restaurants and you start cooking food at home, people will wonder what the heck is going on. And then they'll start criticizing. And then they're going to start talking behind your back. They're going to tell your friends, oh, I think something's wrong at their home. I think they're having financial issues. I think that they're having some marital issues. I think they're having some other problems. I don't know what's going on. He's not as fun as anymore. He doesn't really care about having fun. All he's cared about is money. He's this money-hungry person. She is this money-hungry person. People will talk. People love talking. It's what they do. So this is where you might as well give people a good reason to talk, because then you go through this decade of sacrifice, and then you're going to come out with the fruits of that decade of sacrifice, which is now you'll have the ability to have a much bigger and nicer home. You'll have the ability to drive a much nicer and fancier car. You'll have the ability to have the nicer and more expensive vacations. But in order for you to get there and be able to have those nice things without having to worry about the money, you got to be willing to put in that sacrifice and go through all the criticism, go through all the hate, go through all the judgment, and not worry about what they think. This is where you got to build your team, and your team is your house. You got to talk to your spouse, your husband, your wife. You got to talk to your kids and lay the foundation of what's going on, and know that this is a part of it, that you're going to be making some sacrifices, that people are going to criticize you for what you do, but you're working for something bigger, and most people don't understand what that bigger is. But if you stick with it, that's what's going to give you the opportunity to have the financial freedom that nobody else has. And everyone's going to wonder then how you did it. Now, the last thing that I want to touch on for this video, which is really important, is why it's so important and crucial for you to build this wealth sooner rather than later, because of what's going on with inflation, and particularly people's opinions about the real cause of inflation, because there's a lot of mixed opinions out there, and we're clearly still seeing inflation still around. We're clearly still seeing high interest rates. We're clearly still seeing a lot of different emotions and changes in the economy, and this is where I want you to be aware of what's happening. That way you can take care of yourself, your family, and your community. There's been a lot of talk recently about the real and root cause of inflation, where you've had a lot of media articles saying that corporate greed is what's causing inflation, and it's the reason why inflation is still here, and it's the reason why inflation is not going down. That corporate greed, wanting to maximize their profits, is why we are seeing the inflationary issues. It's why Americans are struggling to survive. It's why Americans are struggling to succeed, because we have all this corporate greed. Now, I want to address this because all the blame for inflation is being tied to corporate greed. And I think the first thing that I want to highlight here is people are saying that corporations are greedy, and because of that, inflation exists, which really doesn't make much sense. Because for one, obviously corporations are greedy. Why is that news? It's like saying water is wet. Corporations are in the business of making a profit. If you were in the business of selling microphones and you tested the markets and you saw, okay, people saw this microphone at $200 and they weren't going to buy it, but they will buy it at $210, and I'm going to make a bigger profit at $210, I'm going to sell it for $210. Your job as a corporation is to sell products at the right price that's going to give you the most sales. That's what a corporation does. Period. Banks are in the business of lending money. They want to lend you as much money as possible. Corporations are in the business of selling stuff. They want to make the biggest profits possible. You are in the business of getting the best salary possible. Is it employment greed when you ask for a salary raise? Is it corporate greed when corporations want to make bigger profits? Because if corporations don't make bigger profits, they can't pay you a bigger salary. If corporations don't make bigger profits, they can't even employ you. So it's very interesting to see the way that things get kind of played about, but you don't see the opposite when employees want a bigger salary. Why is that not employment greed? Or why is it not banking greed when banks want to lend you money? Or why is it not realtor greed when realtors want to sell you a bigger home? Or why is it not salesperson greed when car salespeople want to sell you a bigger car? That's the reality of what it is. Corporations want to sell you more stuff. Banks want to lend you more money. Salespeople want to sell you bigger things. That's how it works. So now let's go back to now, what is the cause of inflation? Well, if it's really corporate greed, let's really dissect this. If I can make this microphone for $10 and I'm selling it for $500 because of my corporate greed, well, what's probably going to happen is somebody's going to say, holy moly, Jaspreet's got this decent microphone with huge margins. I want to enter this microphone business. Now, how about I create a better microphone for $20 and I sell it for $400? Now, then the competitor comes and they start undercutting me, and that's what then causes a correction in the free market. Now, of course, there's a lot of issues going on today which sometimes prevent the free market from working, but in a free market, when you have a lot of corporate greed, that also creates a lot of corporate opportunities for entrepreneurs to come in, find these high profit margin businesses, and then go out and undercut other businesses, which cause the prices of things to go down. That's why technology is actually known as a deflationary industry, because technology causes the price of things to go down. If you don't believe me, look at the price of TVs over the last number of years or decades. Why has the price of TVs come down so significantly? Because of technology. They have allowed the cost of things to go down. So technology creates competition, or one of the reasons why we can see the price of things to go down. Competition can also cause the price of things to go down. But now let's go back to that topic though, of what then causes the inflation, because in reality, inflation only has one root cause, and this root cause can then cause the corporate greed. But it's kind of interesting, because if corporate greed is the cause of inflation, then how come it's not employment greed that's the cause of inflation? Why is it not housing greed when you want a bigger home that's causing inflation? Why is it not Chipotle greed when you want double meat, causing the price of Chipotle items to go up? Well, the root cause of inflation, and the only root cause of inflation, is the increase of the monetary supply. When you increase the amount of dollars out there, you devalue each individual dollar, which then causes the price of things to go up. Because now when you flood the economy with more dollars, people have more dollars, businesses have more dollars. That means there's more consumption availability. Because when you have more access to money, and this could be money in your bank account, or this could be credit, because that's how our economic system works, that it's not how much money you have in your bank, but how much spending ability that you have. When you have more spending ability, well, then there's more upward price potential. Because now when a business does their job and they say, okay, let's market the price of microphones. Should we sell it for $200, $150, or $250? What's going to drive the most revenue, and what's going to drive the most sales, and what's going to drive the most profit? And now the business marketing executives are saying, whoa, it's no longer $150 that's making us the most money. It's $250. In fact, maybe it's $275. Now, businesses have the ability to raise their prices. Now, it's not just the fact that businesses have the ability to raise their prices, it's also that business costs have risen. Why have businesses' costs risen? Well, for one, the cost of raw materials has also gone up. Why has the cost of raw materials also gone up? Because the demand for so many items has gone up. Right? When you print all this money and you throw it into our economic system, businesses and people get access to money, and people start shopping. Everybody starts buying. And now when everybody starts buying, there's more demand, not enough supply. Businesses have to produce more products. Their suppliers then get backed up and they need to produce more products, which then causes the price of things to go up. And in addition to that, labor costs have also gone up. If you've gotten a raise in the last couple of years, well, then that also contributes to the higher reasons why businesses need to make more money, because they have to pay more money. And many times, employee salaries have gone up more than 5 or 7% in the last couple of years. So now when you have costs going up, businesses also have to make more money. And at the same time, businesses are always trying to make more money. That's the name of the game for businesses. Their business revolves around trying to maximize their profits. But this is where it's very interesting because everyone wants to point fingers at something or someone as to the cause of inflation. And now we're seeing the blame go to corporations for doing what corporations do, which is try to make money, which really should not be that big of a surprise. If you're surprised that corporations are greedy, well, you might want to take a couple economic lessons because, well, businesses are in the business of making money. That's what they do. If they didn't make money, you wouldn't have a job, period. The second thing, though, is how come we're not pointing fingers at the true root cause of inflation? If the government wasn't spending so much money, we wouldn't have so much money printing. If we didn't have so much money printing, there wouldn't be so much excess money out there. If there wasn't so much excess money out there, businesses wouldn't even have the ability to raise their prices because people wouldn't be able to spend. And if people couldn't spend and afford a business's higher costs, they wouldn't have the ability to raise their prices. And so then businesses would have to cool down their price growth. Because if businesses can't sell a product for a higher price, if I go to market and I'm looking at the best price from a microphone and I look at $150, $200, and $250, and I see nobody can afford $250 and we can't move enough products, well, either I'm going to stop the production of this microphone or I'm going to find a way to sell it for $200 or whatever the right price point is. And so the root cause of inflation isn't businesses being greedy, because we already know businesses are greedy. That's what businesses do. They're in the business of making money. We need to address the real root cause, which is the government spending, which is funded by money printing, right? The government has been running a trillion or multi-trillion dollar deficit for the last number of years, which means that money has to come from somewhere. If the government spends $1 trillion that they don't have, well, either they're going to borrow this money or this money is going to get printed. If this money gets printed, now the government has just printed $1 trillion out of thin air thanks to the help of the Federal Reserve Bank, and this money gets injected into our economy. Now people have more spending ability. If people have more spending ability, the prices of things will continue to rise. That's how inflation works. And so now when you blame the byproduct of inflation on the cause of inflation, you're never going to get to the real cause of inflation. Now I get it. People are upset about the price of things. People are upset when they see the price of their eggs so expensive and they see businesses selling eggs making record profits. But you got to remember, businesses are in the business of trying to make money. It is a business's goal to make higher profits, and they're going to always try to do that. So instead of trying to tell gravity, stop being gravity, how about you look at the root cause of the gravity and the root cause of the inflation, which in this case is the money printing, which is controlled by the Federal Reserve Bank, which happens because of government spending. The government spends more money than they have or that they bring in, which means they have to print more money from the Federal Reserve Bank, which then causes the devaluation of the dollar, which is inflation, which then causes the price of things to go up, which then causes businesses to raise the price of their products, which forces them now to sometimes make bigger profits, which also forces them to make higher revenues because, well, they're selling more stuff and they're selling their products at a higher price because, well, if people have the ability to spend and the prices of things go up, businesses are going to sell more stuff. Now, of course, we're going to see a lot more pain in the economy as we're working to fix the inflation problem, but there's one root cause to the inflation, and it's not corporate greed. It's the money printing, and that's what ultimately caused the inflation. And so when we talk about inflation, you want to make sure you understand what's really going on because, well, the media, traditional media is always going to put their spin on it, but your job as a financially educated person is to really understand what's going on. That way, of course, you can make the best decisions for yourself, your family, and your community. Everybody wants to be a millionaire, but that's one of the worst financial goals that you can set for yourself. Not because it's bad to be a millionaire, but because most people have a misconstrued conception of what being a millionaire is. I'll show you. Let's assume that you went out and you bought a home for, say, $200,000, and then a few years go by and now your home